What if I told you one single company may have pushed oil prices in Asia to the highest level in history? And now it could be losing billions as that bet unravels. This isn't a conspiracy. This is a real trade. And it shocked the entire energy market. A French oil giant tried to profit from war. That's really what this comes down to. They bet that supply would tighten. Prices would keep rising. And the chaos would last. And for a while, it worked. Prices surged. The whole market moved. But here's the problem. Markets don't stay distorted forever. Now the tide is turning. Oil prices in Asia are suddenly collapsing. We're talking about drops of tens of dollars in a single day. And the company behind this trade, it could be staring at massive losses. Not small losses. The kind that trigger margin calls and forced selling. And here's where it gets even crazier. This isn't just a trading story anymore. It's already leaking into real life. In South Korea, people are rushing to buy garbage bags. In Japan, a snack brand has stopped production. In India, bottled water is getting more expensive. All of this linked back to one giant bet in the oil market. So what actually happened? Let's break it down. At the center of this storm is Total Energies. Not a hedge fund. Not a small player. This is one of the largest energy companies in the world. The kind of company that usually moves markets. Not gets trapped by them. But in March, they did something very unusual. Actually, scratch that. They did something aggressive. To understand it, you need to know something called the Platts pricing window. This is where a huge portion of Asian crude oil gets priced. Think of it as a key battleground for oil pricing in the region. Behind it, a derivatives market worth around $200 billion a year. And then Total Energies stepped in and started buying. Fast. Relentlessly. At a scale nobody expected. In just 1 month, they bought 69 cargoes of Dubai crude. That might not sound crazy until you hear this. In all of 2025, only 347 cargoes were traded there. So in 1 month, they took nearly 20% of the entire year's volume. That's not normal demand. That's force. So the obvious question is, why? Because this wasn't just buying oil. This was a bet. A very specific bet. They were betting on war. They were betting that tensions in the Middle East would keep rising. That supply would stay tight. And that prices would keep going up. And more importantly, they were trying to squeeze the market. In trading terms, this looks a lot like a short squeeze. Buy aggressively in a tight market. Force others to chase supply. And push prices even higher. And for a while, it worked perfectly. As liquidity dried up, prices in Asia exploded. At one point, they hit $170 per barrel. That's not just high. That's historic. And here's what made it even crazier. At the same time, WTI was around $100. Brent was about $120. So Asia was trading $50 to $60 higher than the rest of the world. That kind of gap. Almost unheard of. But here's the thing. Moves like this don't last. They can't. Because Total Energies made one critical assumption. That the crisis would continue. But recently, something changed. Traffic through the Strait of Hormuz started to normalize. Not completely, but enough to calm the market. And once that happened, everything shifted. Suddenly, traders started asking a different question. What if oil is just too expensive? And that's when the trade flipped. Instead of chasing prices higher, people started betting on the drop. And then came the breaking point. This past Wednesday, Total Energies stopped bidding. Just stopped. And the market reacted instantly. Oman crude dropped $48 in a single day. Murban fell nearly $20. Think about that. One company steps back, and prices collapse. That tells you something very important. A big part of this rally was artificial, and now that support is gone. Which brings us to the real danger. Total Energies is sitting on large positions, bought at very high prices, in a market that's now falling fast. That's a dangerous place to be, because losses don't grow linearly. They accelerate. And the biggest risk isn't just losses. It's a margin call. If prices keep falling, they may be forced to add collateral or start selling. And forced selling, that's where things get ugly. Prices fall. Positions get liquidated. Prices fall even faster. That's how you get a cascade. Some analysts believe that if this unwinds quickly, Asian oil prices could crash, even below Brent, from the highest prices in history, to a collapse, all from one trade. But the impact doesn't stop in financial markets, because oil isn't just oil. It feeds into everything. When prices surged, it hit naphtha, a key material for plastics. And plastics are everywhere. Food packaging, cosmetics, tires, toys. So when oil spikes, costs ripple through the entire system. And now we're seeing the effects. Factories facing shortages, prices rising, production slowing, all triggered by one aggressive bet. And that's the real takeaway here. When a giant makes a big bet, it doesn't just move the market, it distorts it. And when that trade starts to break, the damage doesn't stay on trading screens. It spreads through supply chains, through prices, through everyday life. And by the time it reaches you, you don't see the trade. You just feel the cost.